Okay, to retake the concept, the last concept I explained, that is the time value of money. Now, with the time value of money, as I said, we have the future and this present. So the future value of a single commodity is basically the initial investment of a principal that is determined by means of compounding. And by means of compounding, what we mean is that if you have money today and the interest given today is 100,000 and you are giving interest of 10% and you want to invest for the next 5 years, the compound of that is what you call the future value of that money. So it's given by this formula that you see here, the present value formula. Now this equation, and this PV is equals to the present value, and this is equals to what you call the compounding factor or the future value factor. So with this whole situation, this is what we multiply and you get the future value of money. Now, this is also gives us the present value. So from the future value, once we just try to make PV the subject, we can therefore obtain the present value. Now, the present value tends to lose the monetary value of what is invested today as a given interest rate per period in order to grow at the same future amount after end periods. So what this simply means is that if you are being promised an amount in the next 5 years, how is that money compared to today's terms? So you try to bring that future value into today's terms, and that future value into today's terms, this is what we call the discounting factor. So it's a process, the reverse of the compounding process, and this gives us the discounting factor. It tells us that you adjust the money to reflect of today, and that is what we are saying. So we continue our analysis, and now we are looking at financial analysis, planning, and control. So what is financial analysis? It's a necessary to monitor the general financial position of a business to limit the risk of financial failures of the business as far as possible. So in terms of how do you do financial analysis is to do the use a number of tools, which include the statement of financial performance, the statement of financial position, and the financial ratios. So the statement of financial performance is what we just discussed earlier in terms of the cost flow up to the net profits. So the operating costs, we remember we showed a chart on the statement of financial performance. So that is one. Then we can also talk about the statement of financial position. And the statement of financial position, basically, we have also discussed this already. Here we tend to look at issues such as the asset and the liability of the company. And when the asset exceeds the liability, we are saying that the company is of good standing to undertake any other investment it wants to undertake. Then we can also talk about the in terms of the flow of funds in the business. So we can also talk about the flow of funds in the business, and the flow of funds in the business also tends to show how the assets and the employment to the suppliers of a loan. We can talk about the profit remaining after interest has been paid is taxable. So all of this tends to show the flow of finance from one angle to the another. And the last to talk about is the financial ratios. So financial ratios gives the relationship between two items. And these two items is the financial statements, and especially the statement of financial performance and the statement of financial position. So the ratios between these two is what we term as the relationship between these two is what we term as the ratio of financial position. So the financial ratios of a business basically have different parties. That is, we have the interested parties are the financial management with the view to internal control, planning, and decision making. We can talk about the suppliers of borrowed capital to evaluate the ability of businesses to pay its debt and interest. We can talk about the investment analyst who may use the financial ratios to evaluate the business as an investment opportunity. And we can talk about labor unions to view the salary negotiations. So financial ratios are very important. That is when we are able to relate the performance criterion to the financial statement, financial position of the company to the financial performance. This is what it helps to do. It helps to give a guide to financial management, suppliers of borrowed capital, investment analysts, and labor unions. Investment analysts and labor unions. Basically, there are three types of comparison that are significant in this regard. Then this comparison that are significant in this regard is a comparison of the current financial ratios of a business with the corresponding ratios of the past and of the past and of expected future ratios with a view to revealing tendency. We can also talk about the comparison of financial ratios of a business with those of other similar businesses. We can talk about the comparison of financial ratios and businesses with the norm for the particular industry as a whole, with the norm of a particular industry. So this is a sample financial statement of a ABC Capital, which tells us that how we move from we are able to get to the least level of profits, that is from the net sales, from the issues of gross profit. So how do we reduce gross profit with less operating costs? How we reduce operating costs. After reducing operating costs, we get the operating profit. Then we get operating profit, reduce it by tax, and that is the profit before the tax. And after the profit before the tax, we subtract the tax and get the net profit. So this gives us the statement of the financial performance. So these are the issues that we've discussed. That is the gross profit, the operating cost, the operating profit, the operating profit before tax, the net profits after tax, and the dividends to ordinary shareholders, the retained profits, earnings, and these are all what gives the financial position of a company. So this is also the financial position. With the financial position is where we limit our discussion to the asset and liability. And for ABC Capital, in terms of the financial position, you can see the asset and the liability of this company. The assets are the company's owns, and the liability are the company's kind of holdings, and this is the owings. The liability are the company's owings. So once they're able to balance the sheet. Now you see that in terms of the total assets here, in terms of the total liability, basically they balance. So this is a balanced form of sheet. Now we move on to go details into the financial ratios, which I've already talked about. So the financial ratios gives the relationship between two items in the financial statement. So the two items is what I've talked about, that is the financial position and the financial statement. It serves as an important criteria to point out the financial strength and the weaknesses of a business. So this is what gives a signal to businesses and individuals or parties who are involved in businesses, whether the company is doing well or not. And I remember I've talked about the financial management, the suppliers of gold capital, investment capital, and labor unions. So we can first of all talk about liquidity ratio. So liquidity ratio provides an indication of the ability of a business to meet a short-term obligation as they become due without curtailing or ceasing its normal activities. So for example, when you talk about liquidity ratios, where providers of loan capital are interested in liquidity ratios because they give an indication of the degree to which a business can meet its debt obligation fully and punctually. So that gives a signal to the business that whether the business can meet its business, and it's a good thing for a business. We can also talk about the current ratio. We can talk about the current ratio. So under the liquidity ratio, we have the current ratio and the asset test ratio. So the current ratio is where we have the current asset over current liability, which reflects the relationship between the value of current asset and the extent to which current liability of a business. Then we can talk about the asset test ratio. Now the asset test ratio is therefore used in combination with the current ratio as a criterion of evaluating liquidity. So with this one, basically it's given by the current assets minus inventory over current liability, current asset over inventory over minus inventory over current liability. So the liquidity ratio should be evaluated with caution, the nature and the condition of the current assets and the correctness of its values as they are recorded in the statements. And these are things that we should be mindful of. We can talk about the solvency ratios. Now, the solvency ratio basically indicates the ability for business to repay its debt from the sale of its assets on cessation of its activity. So if a company tends to, close up or do anything, it should be able to sell the assets or to sell its asset in order to repay its debt. So capital lenders usually use strong interest in solvency ratios because this indicates the risk level of an investment in the business. It indicates the risk level of an investment in the business. And with the same thing that we talk about the liquidity ratios, with solvency ratios, so we can to mention of two things, that is the debt ratio and the gearing ratio. So with the debt ratio, we are saying that is the ratio may be calculated using the following equation, where there's the total debt over the total assets, the total debt over the total assets. That is the debt ratio. Or we can use the gearing ratio. And the gearing ratio here, we calculate this by rather the owner's equity over the total debt, the owner's equity over total debt. So these are two things that basically we look at in terms of the solvency ratio, in terms of solvency ratio. So most of the things we are discussing here, we've already discussed them, just trying to give a notation to explain all of these things. Now with the gross profit margin, we are saying that is the gross sales over gross profit over sales times 100, the gross profit over sales times 100. That is, all of these are under what we call it's also another form of trying to see the financial strength of a business with the profitability, the rate of return, and the yields ratio. So under these things are what we are discussing the gross profit margin, and the gross profit margin indicates how profitable sales have been. It indicates how profitable sales have been. It gives an indication of the make-up percentage used by a firm. So it gives an indication of the make-up percentage used by a firm. So it is the gross profit over sales. It's the gross profit over sales times 100. We can talk about the net profit margin, and the net profit margin gives an indication of the overall profitability of a firm and management ability to control revenue and expenses. So it gives the whole profitability indication of overall profitability of a firm and the management ability to control revenue and expenditure and sales, and expenses. Now with this, we are saying that it is the net profit after tax over sales times 100. So the first one, that is the gross margin, that is the gross over sales. This one is the net profit over sales. So just take the note on the differences between them. So in order to improve profitability, management needs to consider the measure already suggested for improving the gross profit margin and focus on operating expenses. We can also talk about return on investment. Now, return on investment here, basically, we are saying that this is given by the net profit after tax over total assets, the net profit over tax over to total assets, the net profit over tax over the total assets. So a firm wishing to improve its return on investment needs to consider the same measure as those proposed in respect of the gross profit margin and net profit margin, the gross profit margin and the net profit margin. We can also talk about the return on owners. So the return on owners, we are saying that here, it is the net profit over the owner's equity, net profit over the owner's equity, the net profit over the owner's equity. One major responsibility in terms of financial management is about strategic planning, and how do companies strategically position themselves in order to plan, and they do this by means of budgets. And budgets here, we are saying that is a formal written plan of a future action expressed in a monetary term, and sometimes used also in physical terms to implement the strategy of a business and to achieve goals with limited resources. One thing we should know is that we talk of budget, we can to have different forms of budget. We have, in South Africa, for example, when they read the budget, people tend to find out what the kind of budget. We have the state budget. What we also look at it in terms of a company's budget, in terms of even a own personal budget. So we have different components of budget, and this is what we are going to look at. So budget as an integrating system, we can talk about the operating budget, and we can talk about the financial budgets. So under the operation budget, we are talking about three responsibilities. We are going to center on three kinds of budgets. So we have the cost budget. Now the cost budget too, we can talk about the manufacturing cost budget, and we can talk about the discretionary cost budget. So we can talk about the manufacturing cost budget and the discretionary cost budget. Manufacturing cost budget are used when output can be measured accurately Manufacturing cost budgets are used when output can be measured accurately. And we are seeing that discretionary budget costs are used for a cost center in which output cannot be measured accurately. So in which output cannot be measured accurately. We can also talk about the income budget under the operating budget. So under operating budget, these budgets are the income budgets. For them, they are budgets that are developed to measure marketing and sales effectiveness. So they monitor budgets that are drafted for marketing and sales effectiveness. We can talk about the profit plan and the profit budget. So with the profit plan and the profit budget, this type of budget combines cost and income budgets and is used by managers who have responsibility for both the expenses and income of their units and the income of their units. Now we move on to look at the other aspects of the other type of other type of budget, which is the financial budget. And financial budgets are basically used for the execution of financial planning and control tasks, consist of capital expenditure, cash, financing, and the balance sheet budget. So this type of budgets are prepared from information containing in the operating budgets, integrated in the financial planning of the business, which is operating. And financial budget serves three major purposes. They verify the viability of operation planning. They review the financial actions that the businesses must have to take to execute of its operating budget. They indicate how operating plans of a business will affect the future financial actions and conditions. Now, we have also talked about we've given the types. Now we look at the other components under the financial aspect. We can talk about a capital expenditure budget. So the capital expenditure budget tries to indicate the expected future capital investment in the physical facilities, such as building equipment and so on, and maintain its present capacity to expand the future productive capacity. So in terms of the current budget, we are looking at the budget that the capital expenditure budget that focus on expenditure that are being made in terms of the buildings and other major infrastructure, physical facilities. This is very common in terms of government reading of the budget, where government tries to give a capital expenditure on terms of the rules, on terms of the buildings, the hospital, the physical facilities that the government tries to budget for. So we can also talk about the cash budget, and the cash budget here indicates the extent, the time, and the sources of expected cash flow. The extent, time, and the purposes of the expected cash flow and the expected availability of cash is in comparison with the expected need for it. So we can also talk about the financial budget, and the financial budget is basically developed to assure businesses of the availability of funds to meet the budget shortfalls of receipts relative to payments in the short term. So it has been developed to ensure availability of funds to meet budget shortfalls of receipts and relative to payments in the short term, and scheduled medium and the long-term borrowing of financing. So when we talk of financial budgets, it is therefore developed in conjunction with cash budget to provide the businesses with the funds it needs at a particular point in time. Now, we can also talk about the budget statement of a financial position. So the budget statement of financial position, this brings all the other budgets to project how the financial position of a business will look at the end of the budget period is in actual results terms or in actual terms. So an analysis of the statement of the financial position budget may suggest problems such as poor solvency, whether the company is doing well or not, what opportunities where the company is performing, and places where the company needs to do some form of correction. One other type of budget that we may not also want to overlook is what we call the traditional budgeting. So the traditional budgeting involves using actual income and expenditure of previous year as a basis of making adjustments for expected changes in circumstances. So it makes projections from sales from previous years and tries to use it to budget for we try to use it to project the projected sales of last year and use it to budget for actual expenditure, income, and expenditure today. So I've already talked about the traditional budgeting, and another form of budgeting is the zero-based budgeting. So zero-based budgeting enables businesses to look at its activities and priorities afresh on an annual basis. So it helps businesses to look at its priorities on an annual basis. So in terms of zero-based budgeting, it leads to a better prioritizing of resource allocation and more efficient businesses. It leads to a better prioritization of resources allocation, and more efficient businesses. Now we move on to the concept of asset management. So asset management, and we are focusing on the management of current assets. So current assets include items such as cash, marketable securities, debtors, and inventory. Basically, they are needed to ensure continuous and smooth functioning of a business. So when you talk of issues such as this, these are things that are basically need you should hold on to them to run your day-to-day businesses. So for example, cash is needed to pay your bills, that are not perfectly matched by current cash inflows, while adequate supply of raw materials is required to sustain the business and manufacturing process. Sales may be influenced by the credit of the business that is prepared. So assets are therefore necessary and significant component of the total asset. And this current asset helps your business to survive your day-to-day activities to strive on. As a business, your management of cash and marketable securities should be of concern to you. Now, if you are trying to hold on to cash, that is in terms of cash, we are talking about a currency in the hands of the people. Now, if you're holding cash, it comes at a cost to the business. It may be good at a particular point in time and may also be bad at a particular point in time. So what is the cost of holding cash? Now, there's a loss of interest. That is, if you had, instead of you holding on to real cash and had kept the money in an interest-bearing asset, you could have earned some interest on it. But once you tend to hold physical cash, you do not earn any interest on cash. So that is a cost to the individual or to the person holding the cash. Then you can talk about the loss of purchasing power. Once you hold on to cash and it doesn't earn interest, when there's issues of high inflation, you realize that the value of your money reduces. So your ability to purchase, that is what you're saying, that your purchasing power will reduce. Then we are talking about the cost of holding little or no cash at all. So if you don't hold any cash at all, that is when you hold cash, you have its negative aspect. And if you have no cash too, it also has consequences. So what are the consequences? The loss of goodwill. If you are unable to meet your financial obligations, that is pay your employees and other people raw materials for, people will not want to supply to you again, and you lose that goodwill from people. Loss of opportunity, I just explained. So once people are not willing to offer their services to you because you are not that liquid, or you are not having cash on you to pay back at a particular point in time, the inability to claim discount. So here we are saying that the early payments are very advantageous in percentage terms. So cash shortage may preclude the claiming of such a discount. So if you hold on to cash, you do not claim any discount on it. If you hold on to no cash, then discounts are prompt and early payments are very disadvantageous. Then you can also talk about the cost of borrowing. So shortage of cash may force a business to raise money at short notice at expensive rates, at short notice at expensive rates. So either you hold on to cash or you hold on to invest marketable securities. So marketable securities, we are saying that they are investment instruments on which businesses earn a fixed interest income. So this is what we call the interest-bearing asset. You invest money into interest-bearing assets, into securities, bonds, and other stuff. So these are what we call the market securities. Now, in terms of holding on to cash, there are basically reasons to have a certain amount of cash available. That is the reasons to have businesses would want to hold on to cash. It's basically for the transaction motive. That is, transaction motive is where you hold on to money to buy something, to transact, to undertake transaction. Precautionary motive for unforeseen circumstances. You don't know when maybe something will happen. Why a business will hold on to money? They hold on to money for unforeseen circumstances or contingencies. So sometimes some debtors will come at a default time or at a time where you didn't expect. Holding on to cash will help you to meet that obligation. Then another part of holding on to cash is where there's for speculative motive. So for speculative motive is where you hold on to money, you hold on to cash in order to engage in interest-bearing assets. in order to undertake the opportunity cost of holding money. You hold on to money, whether you try to invest in, you try to speculate. If you invest your money, you think that in the near future, interest rate is going to be high and your money is going to be more, interest is going to be more. You tend to hold on to more cash now, or you tend to, if you have the notion that the current interest rate is low and in the near future the interest rate is going to go higher, you invest your money into interest-bearing assets now, so that in the near future you try to make that speculative how interest rate will operate in the near future. So this one is basically determinant on the interest rate availability, whether it is low or high. If it is low, you tend to invest more so that in the near future you're going to have that prediction that the speculative motive that is going to rise, then you get more on the money that you have. So this is where people tend to invest in interest-bearing assets. So now we look at cash budgets, and the cash budget is also very important. And this one, we are saying that we are determining the needs of a business in as important aspect of a cash business. So every business must be able to have a cash budget, which will give you a detailed plan of your future cash flow for a specified period of time. And there are three main components of your cash budget. That's what we call the cash receipt, the cash disbursement, and the net cash in change. So the cash receipt is basically cash from sales, collection from credits, sales, and other sources of such cash. So cash that basically come or injection into your business. Then talk of the cash disbursement, how money are being disbursed or how cash flow out of the business. So these are the broadly categorized as cash paid for purchases of merchandise, raw materials, and operating expenses. Now the differences between these two. So this represents the difference between the cash receipts and the cash disbursement. That is what you call the net changes in cash. Net changes in cash. Now, in terms of business, we have what you call the cash cycle. How the cash evolves, and we are saying that it involves a whole lot of process. In the first stage of you having investing in your cash in raw materials, and after investing your cash in raw materials, you convert the raw materials to finished products. Once you convert them into finished product, you sell the finished product on credit. Then once you sell them on credit, ending the cycle by collecting the cash back. So this is basically how the cycle continues, and it's a continuous process. The cash cycle is a continuous process. When you are managing your cash, one thing you also must manage is your debtors. So debtors arise when a business sells on credit. When you sell on credit, then there's a situation of a debtor. So credit is granted to an individual is referred to the consumer credit, and the credits extended to a business is referred to the trade credits. So debtor accounts represent a considerable portion of investment in current assets in most businesses, and obviously demand efficiency. So in terms of modern, there are three most important facets of management of debtors account for. So the three most important debtors are what you call the credit policy, the credit terms, and the collection term. So in terms of the credit policy, basically contains the directives according to which is indicated, which is decided whether credit should be granted to a client, and if so, how much. So the credit policy contains directive according to which is decided whether credit should be granted to a client or not. Now, in deciding on whether the credit should be granted or not involves around four main standards, credit standards, and this includes the character, the capacity, the capital, and the condition. So the customer's willingness to pay, that is the character, the customer's ability to pay, that is the capacity, then the customer's financial resource, that is its capital, and the conditions, current economic conditions and business conditions. So these things have to be put in place to assess whether the credit policy, stance is also, understood. Now we can talk about the credit terms, and the credit terms here is defined as the credit period and any discounts offered for any payment. So the credit period and any discount offered for any period. It can be maybe 10 days for full payment, or you have to pay. For example, somebody gives you a credit and tells you that in the first 10 days, do not pay. After that, then you come to pay. After you mortgage a house and you're asked not to pay for the first 1 month or something, then you're asked to pay later on. So that's what you call the credit terms. You are given some form of discount and offer to pay. for early payments. You are giving is defined as a credit period and any discount offered for any early payment. So either you just postpone the payment today, or you can ask people to also pay. So if you tend to pay in, for example, if you are buying a phone and you are buying it on credit and you buy it in the first 1 month, you are asked to that in the 1 month you pay 10,000. If you want to pay it in the next 2 months, you pay 12,000. It's just to encourage people to pay in early terms. Then we are also talking about the collection policy. So the collection policy here concerns with the guidelines for the collection of a debt account that has not been paid by due date. So this one try to give a guidelines as to what you call bad debt, people that decide not to pay. If people want to pay, there are certain processes which need to be followed for them to be paid. So this is the credit policy, which I've already discussed the 4 main standards in terms of the character, the capacity, the capital, and the conditions. Then the collection policy, which gives the guidelines for collection of debt accounts, and the cost of granting credit should include the loss of interest, the cost associated with determining consumers' credit worthiness, the administrative and the record keeping cost, and the bad debt. And these are all important things. That is when in terms of the collection, in terms of the interest that has been lost, in terms of the cost associated with determining customers' credit worthiness, in terms of the administration. So the cost of granting credit should include this, because once you give your money out, now you don't have interest on that. So sometimes that's why people tend to add interest when they are giving money out, so that people tends to, that will tend to cover that. And the cost associated with determining the customer credit worthiness, it also comes at a cost to the person who is giving the loan, because if somebody you want to give a loan to somebody, you have to determine the person's credit worthiness. That is why sometimes people going for mortgage, you are asked to go and buy something and let us see your credit worthiness before they want to give you that kind of the loan, or that kind of assurance that you are going to pay. Then administration and record keeping, that is how you keep records of all these things, because now there should be a particular unit that will tell the person's credit viability, whether the person is of having a good standards in terms of payment and tracking. Then we can also talk about bad debt, that is loan that is not paid. Loan that is not paid. One other form of management in terms of financial management is the stock management or inventory. Now, inventory stock includes raw materials, the auxiliary materials, the work in progress, semi-finished goods, trading stocks, and so on. And like debtors, it represents a considerable portion of investment in the working capital. So you must be able to manage. And if you tend not to, the cost of holding all these inventory stocks also comes at a cost to the business. So it is very relevant in financial management to combine all these relevant variables. Now, in terms of the cost of holding into this inventory stocks include the loss of interest and the storage costs, the insurance costs, and the obsolete. Now, on the loss of interest here, we are saying that interest that could have been earned on the money that is tied up is we are holding on to that money in terms of inventory. If we had rather done something now, we are just leaving the stock in terms of the raw materials there, and we are losing interest. So in terms of the storage cost, the place where you are saving these goods, you are also paying for them. Now, in terms of the insurance cost, then holding inventory stock exposes the business to risk of fire and theft of the stock. So people tend to steal or may also have some other external costs on the firm. Then we'll talk about the obsolescence. Now, in terms of obsolescence, costs can become obsolete. For example, they may go out of fashion. That is when we keep certain things in stock, either they expire or it becomes non-usable. Then we can also talk about the cost of holding little or no inventory. If you also don't have this goods in terms of place, in terms of the raw materials, you're able to keep them or have nothing of them. It also comes to a cost to the business. The loss of customers' goodwill. That is when customer needs certain goods at the store. Maybe you may not have, you may run out of stock, and will also affect the businesses. We can talk about the production interruption dislocation. That is running out of stock can also be very costly for certain types of companies, because when you also talk, your other customers can go to different places to buy their goods. Then loss of flexibility, that is additional stock holding creates a safety margin. It creates a safety margin where mischiefs of various discretion can be accommodated without major and costly repercussion. We can also talk about the reorder cost. Now, with reorder costs, we are saying that a company existing on little or no stock will be forced to place a large number of small orders with short intervals between each of them. Now, each order gives rise to a cost. Each order gives rise to a cost, and this comes to greater cost to a business. In managing the assets of the business, you must also try to manage the long-term investment decision and capital budgeting. So what is capital? Capital investment involves the use of funds of a business to acquire fixed assets such as the land, buildings, equipment, and other machineries, of which accrue over a period of a longer term. So the long-term investment decisions therefore determines the type, the size, and the composition of business fixed assets, as well as the amount of permanent working capital required for the implementation and continued operation of the capital investment projects. Now, in terms of this, once we also tend to look at the importance of the capital projects, it reflects by the following three factors. So the importance of a capital investment project is reflected by the following three. That is the relative magnitude of the amount involved, the long-term nature of the capital investment decision, the strategic nature of the capital investments project. So the amounts involved in capital investment are much larger than those relating to. So, and in terms of the long-term nature of the capital investment decision, here we are saying that the benefit from capital investment may accrue in periods varying from 2 to 3 years, as much as 30 to 40 years. Then in terms of the strategic nature of the capital investment projects, here we are saying that the investment decisions of a strategic nature, such as the development of an entire new project and the application of new technology, the decision of diversified internationally, or decision to embark on rendering a strategic service could have a profound effect on the future development of a business. Now, in terms of every investment we do, we need to evaluate and see whether the investment is viable or not. And to see an investment being viable, then the basic thing for you to do is to do what we call the cost-benefit analysis. So the basic principle underlying the evaluation of any business investment decision-making is the cost and benefit analysis. So two additional factors require further consideration when comparing the benefit and the cost. Then these two factors include the benefit and cost occur at different times. That is when you are considering that the benefit and cost occur at two particular different points in time. Then we can also talk about the fact that the cost benefit are accounting concepts that do not necessarily reflect the timing and the amount of payment to the business. These are two things that when you're analyzing the business, we should take into consideration. Yes, so we can also talk about the cash flow concept, and the cash flow concept is also one way in terms of how to evaluate the projects. And if what we just talked about, the cost and benefit is not working, you can use the cash flow, which basically represent the cash transactions, and there are three instances. So another three instances, we can talk about the initial investment, which basically is the initial money paid when we are beginning a project. And we can also talk about expected annual cash flow over the lifetime of the project. We can also talk about expected terminal cash flow relating to the termination of the projects. So for evaluation purposes, we can have a net cash flow, and the net cash flow will have to go through these levels. That is the initial investment represented by CO, the annual net cash flow, the lifetime of the project, and the terminal flow of the business. So one way in terms of estimating the cash flow is to use the net present value. Now, the net present value tells us the viability nature of a business and deciding on an appropriate discounting rate. So one important thing about this net present value is that when it is positive, it means that the business is viable and it is encouraged for businesses to undertake the project. If it is negative, it's the other way around, and we have to reject the projects. So in terms of also projects, we also have to know that in terms of evaluating the projects, there's also risk and uncertainty. So risk is defined as the deviation from the expected outcome. and the risk may occur or may not occur. Uncertainty describes a situation where the managers are simply unable to identify the various deviations and are unable to assess the likelihood of this occurrence. So uncertainty, we have no clue as to what was going to happen. But with risk, we tend to know, we can measure and find out that there's going to be, it's unknown, but there's likelihood of something occurring and likelihood of something not occurring. And these are things that we also need to consider in terms of evaluating it. Now that we have understood financial system, we are looking at the financing. So now we are looking at a concept of financial market and financial institutions. So financial market basically are the channels through which holders of supplies of funds make funds available to those who require additional finance. So financial market is basically a market where funds are being made available to people who may need it. Then we have the institutions. So the institutions are those, the intermediaries. These are the banks and other places where we tend to transfer this the available funds that are made by the markets to the respective people. So the financial intermediary is the process through which financial institutions pull funds from savers and make them available to those who require the finance, So in terms of financial market, we can talk about the primary and the secondary. So new financial claims or new issues of financial claims are what we term as the primary financial market. And in terms of when we trade in securities, after they have been issued, have taken place, is what we call the secondary market. So when there's a new claim or the new financial claim to the system, then we are saying that that's a financial market, a primary financial market. And when trading has already occurred and trading in securities after they had been issued taking place, is an issue of what we call the secondary market. So there are two types of also financial market we have to also understand. That is the money market and the capital market. So the money market are basically the markets where the financial instruments are short-term. They are short-term maturity. So once you invest your money in a short for 3 months, 2 months to earn interest, those are money markets. Now, in terms of the capital market, these are the long-term investments and are raised and traded by investors on the capital market. So basically, that's what we call the stock exchange, where maybe the government of South Africa tries to make it available. It takes a longer period for it to mature, and those are what we call the capital market. The stock exchange mostly takes place on the Johannesburg Securities Exchange. The long-term investment transaction of this nature can be done privately. One thing that we should know is that such nature can be done privately. So financial institutions can also have two types. That is what we call the deposit-taking institutions. And the deposit-taking institutions are basically the private sector banks, Barclays, Nedbank, FNB, all these are deposit-taking institutions. And we have the non-deposit-taking institutions, which basically undertake other forms of activities. There's insurance, short-term insurance, such as the Out Insurance, Satam, Mutual and Federal. We also have the life insurance, Old Mutual, and there's pension fund, provident funds. All these are the non-taking institutions. For them, they do not take this deposits of individuals to let money grow, but they rather undertake other forms of activities. And the deposits are basically the banking activity where you go to deposit money, and the banks try to give your money back to the people to create more money into the system. So credit that is given to businesses, that is what we are terming as the trade credit, and basically in the form of suppliers credits. So prompt payment is often secured in the form of rebates, and then it has its own advantages. So we can talk about the ready available of businesses that pay their suppliers regular. It is also informal, and it is more flexible than other forms of short-term financing. So this is what we term as the trade credit. So accruals is also a spontaneous finance. Now, accrued wages basically represent money that a business owes its employees. Accrued tax is a form of financing which is determined by the amount of tax payable and the frequency with which it paid, Now we can also talk about bank overdraft. So bank overdraft is also a short-term form and short-term financial instrument. So overdraft facility allows businesses to make payment from a check account in excess of the balance in that account. So that is what we call overdraft. So for example, if you are having a bank, you are owing you have your own account with the bank, and the bank you can do overdraft. That is, you can go in excess of the amount available, and basically you have to pay some charges and some interest on that. So basically, these are things that are mostly common in our locals, and these are the things that we're explaining. So it bridges the gap between cash income and cash expenses. The interest charge on overdraft is negotiable, and it is related to the borrower's risk profile. The interest is charged daily on the outstanding balance. Interest is charged daily on the outstanding balance. One other short term of financing is what we call the debtor financing. Here, it involves the sale of debtor to a debtor financing company. And when we talk about this here, we are saying that it involves invoice discounting. So it is the sale of existing debtors and the future credit sales to debtor financing company. Then factoring is similar to invoice discounting. This is similar to factoring. It's just similar to invoice discounting, except the financer undertakes to administer and control the collection of debt. So the matching approach, some of the short-term financial approach, we are talking about the fact that we can have the matching approach, we can have an aggressive approach, and we can have the conservative approach. Now, shareholder equity, in terms of the long-term financing, shareholder interest, we can say that this can be subdivided into the owner's equity and the preference equity. So owner's equity consists of funds made directly available by the legal owners in the form of share capital. Then the preference shareholders' capital falls between the debentures and ordinary shares in terms of risk. So the owner's equity, that is the ordinary shareholders, are true owners of the business. Those are the true owners of a business. And with these two ordinary shares, we can have the pair value shares, the non-pair value shares. So the co-owner of a business, that is the ordinary shareholder, has a claim to a profit, This is the co-owner of the business. He was able to contribute his share. He bought some of the shares in terms of the shares that were used, in terms of the money generating in financing the business. And he's entitled to claim a profit when the company makes profit from the business. We can talk about some of the characteristics of ordinary share. The liability of ordinary shareholders is limited to the amount of share capital they contributed to in the business. No certainty that the money paid for shares will be recouped. Ordinary shares listed company are tradable on stock exchange. Ordinary shareholders are owners of the business and usually have full control of it. Business has no legal obligations to reward ordinary shareholders for their investment in shares. Share capital is available to the business for an unlimited period. And basically, these are things we've talked about in our early discussion in terms of the types of business, in terms of the shares and ownerships. So these are things we're already familiar with. In terms of the preference shareholders' capital, there are two types of the preference share. That is the ordinary preference share and the cumulative preference share. Now, the characteristics of the preference share is have a preferential claim over ordinary shares on profit after tax, and have a preferential claim over ordinary shares on the assets of the business in the case of liquidation. The term of availability is unlimited, and the authority can be varied between full voting right and no voting right at all. Now we are looking at long-term debt. Now, long-term debt are debts that had to be paid in more than a year, or in a year time or more. So we can have two ways. We have the loans, and the loans we can talk about the debentures, the bond, registered terms of loans, and we can have the financing leasing, that is the direct financing leasing, and the leaseback agreement, Now, in terms of the sources of financing for small businesses, basically these are things we've talked about: personal funds, loans from relatives and friends, trade credits, loans or credit from equipment sellers, mortgage loans, commercial banks, loans, small business loans taken in partners, selling capital shares, and venture capital funding. These are things we discussed in our earlier lecture, and we are seeing them here again. So in terms of the capital we've talked about, we are seeing that the capital also has its costs. And for us to understand this concept is that the financial management should be able to, once you hold on to capital, it comes at a cost, but as a management in finance, what we are trying to drive your attention to is that you should be able to know when to keep money and when not to keep money, when to hold on to capital and when not to hold on to capital. So it is necessary to only hold on to the amount of capital that is necessary. You hold on to which is necessary and do not just get into excess where it comes at a higher cost or at a lower cost. So cost in terms of the cost and the risk involved in keeping this capital should be kept at a minimum. And in terms of capital investment decision, cost of a capital serves as a benchmark for investment proposals. In financial decisions, various types of capital earmarked for financing investment or for businesses should be combined so that the cost of capital to the business is kept at a minimum. That is all what we are driving at. And also we are saying that in terms of risk, for an investor, risk constitutes two components. That is the possible loss of a principal sum, that is the original amount investment, and the possibility that no compensation will be paid for the use of the capital. So as an investor, one thing you should know is that it involves risk, and how do you do to mitigate try to position yourself in a better position so that you do not find yourself wanting, that you do not lose your principal sum, and also the fact that when you lose it, you are not compensated for the or you not be compensated or be paid the amount of capital that you used or invested in the business. In that note, in terms of our discussion today, we've looked at issues of financial management. We've looked at their concept, the techniques, the goals of financial management, how to analyze finances and planning tools, the management of asset structure, and the guidelines to sugar short-term and long-term investments, the nature of long-term and its characteristics in terms of the capital, the factors involved in determining the cost of capital, the risk analysis involved. So this is where we'll end our today's discussion. And I try to summarize most of the concepts here so that we will be able to, get back to our continue our tutorials and give you ample time to ask more questions for next week exams.